Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's go up to Canada here. The railroaders, they're striking. I think that's a big deal, but let me ask somebody who knows about this stuff. Lee Klaskow, he's a senior transportation analyst for Bloomberg Intelligence. Lee, is this Canadian National, Canadian Pacific? They're striking it. Do we have that right? And what does it mean?
Well, they've locked out their employees because the union threatened to strike.
Okay.
So for railroads, you have to kind of shut down operations safely to make sure that, not only your employees can get home, but also, the equipment is safely stored. So that's kind of what we've seen happen. That's obviously going to impact volumes of the Canadian rails, both Canadian Pacific and Canadian National. They make up around 25% of originated carloads in North America. And, the impact will be felt across the supply chain because it's not just a Canadian thing. It's also going to impact the rails that they interchange with. And also both Canadian Pacific and Canadian National also go into the United States. CP also goes directly into Mexico. About a third of Canadian National's volumes or revenues, I should say, are tied to cross-border traffic. So, it's not just going to be impacting Canada. How we see it playing out is that these kind of work stoppages don't last that long typically. Usually they're usually forced into some sort of arbitration. When it starts really impacting the economy, the Canadian government kind of took a hands-off approach going into Thursday when the deadline was there. They might take more of a kind of a direct approach now that freight is stopping to flow. And for the railroads, the two railroads impacted, it's going to impact their earnings. A lot of the freight is going to be just delayed. It's not necessarily going to be lost, but some of their, more truck competitive freight, like intermodal, that's a little more time sensitive, could get lost to other modes, namely trucks.
You've also talked about how, due to the different labor disruptions, shippers have been diverting freight from those Canadian ports toward the U.S. West Coast. So what I'm wondering is who kind of wins and who loses from this? Because you've also talked about how this sort of situation has helped boost Union Pacific and other sort of intermodal traffic in recent weeks.
Yeah, so how we see this playing out is who's going to benefit. Well, if it's freight that's headed into Canada that's going to end up in the United States, it's not going to go into Canada because the steamships are going to avoid those ports due to the work stoppage. So they might try to bring that freight into Southern California or the Gulf Coast and the East Coast. But that being said, the Gulf Coast and East Coast are also facing, those ports are also facing their own labor issues. They have a contract that comes up in September 30th with their unions. And right now, there doesn't seem like there's an agreement, at least in the near term. So, a lot of shippers have been redirecting their freight to Southern California. So then who wins? Well, big winners would be Union Pacific and Burlington Northern, and also in Burlington Northern, that's a wholly owned subsidiary by Berkshire Hathaway. And so also some of the intermodal players might benefit too, because you'll have maybe longer lengths of haul, which should drive higher revenues for the players. And also, we expect to see a little bump in truck spot load rates next week, as maybe more and more capacity might be needed to move that time-sensitive freight that's being impacted by the Canadian labor strife.
Lee, I wonder is this time of year particularly crucial? I'm thinking about the retailers maybe stocking up their shelves, getting ready for the holiday season. Was this time period chosen, or is this just happenstance?
This is happenstance. This
Okay.
is just like when their contract came up. And not all labor issues have been terrible this year. CSX yesterday announced that they reached an agreement 4 or 5 months ahead of their deadline with about 25% of their unionized workforce, which included a 3.5% pay increase on an annual basis over the next 5 years. So it's not all bad news for labor, it's not all bad news when it relates to labor, I should say. We hope that things in Canada come to a close and the rails get back to work, not only, for the economies involved, but, the people involved as well.
What does this mean for commodities traffic growth from here? Because it's largely dependent on the pace of course, China's economic recovery, and since it's also a major importer of North American materials as well.
Yeah, so, as China goes, so does commodity demand globally. In addition to covering railroads, we cover marine shipping, the dry bulk and tanker market as well. They're a major player and importer of goods. Their economy has not been as good as many were expecting, and that is definitely going to have an impact on demand. With rails, what we should see on the commodity side is a lot of lumpiness in the weekly volume data that we get from the trade association, the American Rail Association, and so while a lot of that freight is not going to get lost like to other modes, like maybe more truck competitive stuff, it's just going to get delayed. So it's going to create probably more lumpy earnings for Canadian National, Canadian Pacific in the third and fourth quarter. Probably it's going to weigh on the third quarter and maybe be somewhat of a tailwind in the fourth quarter.
All right, Lee, thanks so much for joining us. Always appreciate getting your views there. Lee Klaskow, Senior Transport, Logistics, and Shipping Analyst for Bloomberg Intelligence, joining us via Zoom from Princeton, New Jersey on that. Canadian Railways, they lock out their workers as talks fail, snarling trade there. So that brings up the risk of a possible strike here. So Lee is our global leader of all that trucking and railroads and logistics and all that kind of stuff. So he is our go-to guy there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's go to out to Jackson Hole, Wyoming, a little bit more west of Chicago. Michael McKee joins us there. He's Bloomberg International Economics and Policy Correspondent, and he is an authentic Western dude, born and raised in Colorado State, the whole thing. So he's at home out there. Tom Keene in the suit and the bow tie, not so sure, but Michael McKee fits right in there.
Look, the cowboy hat.
I know, he's sporting a cowboy hat.
Here we go. I was waiting for it.
For our friends on YouTube. Michael, what's the...
Everybody asked, so...
I know, exactly.
You delivered.
And you delivered, no question. You're bringing the game. What's the feeling out there in Jackson Hole, Mike? What is the expectation for Fed Chairman Jay Powell tomorrow?
Expectations aren't really high that he's going to give us a whole lot new. He'll say that the inflation numbers have been good. They have more confidence about reaching their 2% inflation target, and that it may soon be appropriate to change policy. He doesn't want to commit to a September 18th rate cut because we do have data coming in, 2 inflation reports and a jobs report that could change their mind, I suppose. But I think what he wants to do is leave the markets believing they're going to cut without guaranteeing it.
And of course, we've had a few different Fed speakers this morning. As you know, so Kansas City Fed President Jeffrey Smid, obviously speaking on Bloomberg television earlier. So he was talking about how, especially if you're thinking about the payroll revisions, don't really change how they were thinking about policy. But then something else that I thought was interesting was Patrick Harker was speaking about how he already thought markets have priced in a move for Fed action. And he also said that the easing cycle may put the Fed funds rate near 3%. I thought that was interesting, because he was a little bit more specific than some of the other Fed speakers that you've heard. What's your kind of takeaway from this as far as gleaning some of this new information from them ahead of, obviously, Powell tomorrow speaking?
Well, it's pretty clear the markets have priced in at least one rate cut, a little bit more than one at this point as they keep their options open. You can see that in the futures and the overnight index swaps. But the idea of what neutral is going to be and where the Fed is going to end its rate cutting cycle is going to be a big matter of debate going forward. A lot of people from the Fed say we don't know yet because we're not sure what's happened with the demand level, the potential growth in the economy. I don't want to get all wonky, but basically R star, as they say. And if it has gone up, then they cut less. If it's gone back to pre-pandemic levels, then we could get down around 3 or so. They don't want to go much further than that because they want some space to cut rates. And the one thing they will all tell you, they don't have a number yet, but they say it will not be zero again.
Michael, is the feeling out there in Jackson Hole that the Fed, in terms of timing of cutting rates, that they're on the right glide path, or is there concern that maybe they're a little bit late here as we look at some of this data over the last several days and weeks?
Fed folks don't think they're late. You get the argument from Wall Street that they might be. There are people on Wall Street who think the Fed's behind the curve. But their view is you look at the data, and the data aren't telling us the economy's falling off a cliff. Jobless claims this morning barely moving, and on a non-seasonally adjusted basis, actually going down. There's no layoffs happening. And what they're hearing from their constituents, the CEOs and companies in their districts, is that there's still demand out there. People are still spending money. Not as much, not as fast, but they are still spending. And so the outlook is still pretty good, which means they don't feel an urgency to move that some people on Wall Street would like them to have.
It's interesting looking at the moves in the bond market. So after we heard from Kansas City Fed President Jeffrey Schmidt, you're actually looking over at the 10-year yield rising. It's close to about 384 right now. So he was saying about how more data is needed for a rate cut. But when you're hearing that type of rhetoric, is that just basically them trying to signal, don't expect, say, a 50 basis point rate cut at a September meeting, something that aggressive, to be thinking more, maybe a more measured pace in line when it comes to markets and their anticipation for this?
It depends on who is talking.
Right.
Jeff Schmidt represents the Kansas City district, which has traditionally been one of the more hawkish on inflation. So it's understandable that he is reluctant to commit at this point. But I think they all want to leave the impression that we're about to start a cutting cycle. If it's not going to be in September, it's going to be shortly after that, unless we see some sort of dramatic reversal in inflation. They just don't want to have to ratify the market's wishes and start cutting too far too fast.
All right, Michael McKee, thank you so much for joining us. Thank you for the cowboy hat. That
I love
makes the hit. Michael McKee, he's not just a cowboy. He covers all the economic stuff for Bloomberg News Intelligence, but he is a Colorado native, so he fits in
That
right
is.
out there.
I'm so excited we got to see it. This is a suspense of us waiting to see if the hat was there, and he delivered.
It'll be interesting for the Fed Chairman Powell tomorrow. I mean, he doesn't have to do a whole lot tomorrow.
So the options market, actually the volatility that had been priced in, it's come down pretty dramatically. So right now the options market's pricing in an 0.8% swing for the S&P 500 in either direction. And for context, last week it actually had been over 1%. It had been around 1.2%. So really it's just based on the positioning and investors expecting volatility to fade. And a lot of it because we've talked about, we've already had at least a half dozen Fed speakers come out and signal that rate cuts are expected next month. So really it's all about what traders are talking about, the tone, and if he keeps that tone going tomorrow.
Exactly. And then I'll be interested to see kind of the pace of rate cuts, how they cut rates going forward. Is it 25 basis points each meeting, every other meeting? Does he front load with 50? It'd be interesting to see how this all plays out.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Jess Menton sitting in for Alex Steele here. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well, so check us out there. Brian Jacobsen joins us here. He's the chief economist at Annex Wealth Management, joining us from Brookfield, Wisconsin via that Zoom thing. Hey, Brian, thanks so much for joining us here. We're about to hear from Fed Chairman Jay Powell tomorrow out in Jackson Hole. What's your view of the economy right here?
Yeah, I think, well, it obviously had to change based upon some of those BLS revisions that we got as far as suddenly, poof, there goes 818,000 jobs. But for the most part, my view is that we went from great growth to good growth to now sustainable growth. And obviously, the trick is whether or not that sustainable growth will tip over into a recession. We don't necessarily think that it will. A lot of that does depend upon the Fed beginning to really take its foot off of the brake of the economy. It's been trying to slow things down. We don't necessarily think that it needs to really completely take its foot off of the brake. That's just not their style. They are likely to do a 25 basis point cut. I think Collins from Boston said it pretty well about being very slow and methodical about the rate cuts, which is very different than what they did in the past, which is they'd be slow and methodical and hiking and then have to cut aggressively. And now it's the complete opposite of that. Aggressive hiking, more slow, methodical cutting on the way.
And looking at the latest Atlanta Fed GDP model, for the current quarter, it has growth around 2%. As you know, that can be very volatile at times. Another thing I like to look at, though, Paul, in the terminal is a function ECFC, so you can look at the economic forecast annually as well as quarterly, but you're still seeing strength there. So whenever people are pointing to, say, for instance, Brian, that last July payrolls report that saw a slowdown in hiring, that was just one report, of course. We haven't seen a trend of that just yet. Where exactly do you see when people are trying to argue for the weakness here? Because when you're looking at consumer spending, that obviously makes up the bulk of GDP, more than 2/3 of that drives the economy. It still seems like people are, maybe they're shifting which type of retailers they're going to, right? When we see results from Walmart and Target here, it kind of diverging paths, but it still seems like there's a strong consumer out there.
Yeah, the consumer is strong, but not as strong as they used to be. And I think that's one of the key things when people are talking about some of the weakness. A lot of that is focused more on what's been going on with small and medium-sized businesses in the United States, high cost of financing. They've seen really orders being canceled over the last few years. Manufacturing in particular has really been struggling. I think it's been like 21 months in a row with maybe one or two of those months above 50, but for the most part in recessionary territory. The service sector activity has stayed rather buoyant. But now the fears are more about what is happening next. It's not necessarily disagreement about where are we now, but where are we headed? And I think that's where you see some of these early indicators. You know, the Walmart and Target earnings, I think, were good examples. Why is it that they've been doing well? Because of discounting. Customers really view it easier to buy, say, throw pillows to spruce up a room as opposed to doing a complete remodel, right? And so that benefits Target at the expense of, say, Home Depot or other companies that are more in that higher ticket price, things that maybe need to be financed. And so I think the consumer is strong, but not as strong as they used to be.
What's the risk here that the Fed is late and this economy is really at risk of a recession? Maybe even there's some folks say we're already in one.
Well, yeah, I think that they are late, but that doesn't necessarily risk a recession because of the resiliency of the consumer and the overall economy. In fact, with the rate cuts coming in September, you know, maybe they should have done that back in July, if not sooner. Maybe they should do 50 basis points. It's not necessarily about saying what I would like them to do, but what I think they will do, which is that 25 basis points. And so if they slowly take their foot off the brake, I think that's going to be good enough for the economy to avoid a recession. I don't think we need any sort of outsized move higher. I would like to see a bigger move higher, you know, basically to allow that real federal funds rate, the inflation adjusted one, to come back down to something that I think is more on target with that 2% inflation that we're headed towards. But the Fed is likely to deliver kind of weak beer here in terms of a 25 basis point cut. Maybe the big disappointment is that even any cut is not necessarily going to accelerate economic growth immediately. The initial effect is actually to serve as an economic drag as people pull back their activity, the borrowing, waiting for something more meaningful until maybe you get 4 cuts under your belt. Because does it matter if it's 6.5% on a mortgage versus 6.25? Probably not. But 6.5 versus 5.5, that's a bigger difference.
Talk to us about some of your favorite corners of the economy, especially when you're thinking about those closely tied to growth when it comes to industrials, consumer staples, energy, as well as financials.
Yeah, some of those have been a little bit painful. We've been overweight energy for a while, just thinking that these companies are cash cows and they're probably going to continue to do well. The big disappointment there has really been on the demand side of the equation in terms of China's growth being very slow, helping to push down oil prices. But still, from that fundamental basis, the cash flow generation, we do like that area. And they could get a boost if we do see an eventual reacceleration. But we're not banking on an economic reacceleration for some of those more cyclical areas. Those are more based on, let's say, the valuations, and that a lot of these companies have already gone through an earnings recession. If you look on the Bloomberg terminal, as far as the FA function for the financial analysis for these different indices for the different areas, you can see how it is that small and mid-sized companies, they have been in and out of recession for basically the last 2 years. And now the expectation is for that earnings recession to continue for the next couple of quarters. That seems pretty realistic. So if that's already priced in, maybe we could actually see the valuations provide a bit of a foundation for longer term gains in those areas.
I'm glad you brought that up because, of course, Bloomberg Intelligence, Paul, if you crunch Gina Martin Adams' team over on the equity side, they actually had been talking about coming into this quarter how the rest of the S&P 500, the 493, were actually going to have internal profit growth when you're excluding those Mag 7 type companies. And so even though we're seeing maybe some of the growth pull back a little bit for big tech companies, of course, the comps year over year, it's hard to match that when you had that gangbuster revenue forecast last May in 2023, of course, from NVIDIA. But when you're looking ahead to sort of the remainder of those companies, maybe not even just the 493 and the S&P 500, but you were just talking about small caps and mid-type cap companies. What else do you need to see there? Because people talk so much about small caps. Obviously, you're an economist, but when you're thinking about sort of the pain that we've seen reflected in the equity market, say with the Russell 2000, we saw it really outperform the broader benchmarks in July, but then pull back at the start of this month. At what point do you see kind of a turn there? Because we do know that a lot of those smaller companies are very debt heavy oriented, and what that could mean if there could be some relief there if we get some rate cuts on the way the rest of the year.
Yeah, the rate cuts would help because when you saw that massive rotation from large cap to small cap, it was around the time that we got that decent CPI print where it suggested that, okay, rate cuts are on their way. And then you also then had Trump's popularity rising, and so maybe some regulatory relief. Since then, we've seen Trump's popularity decline, and we've also seen some resiliency with some of those mega cap tech stock, their earnings. So even if the stock prices are pretty volatile, the fundamentals seem pretty well intact. Now, one of the big areas is I just think don't underestimate the power of low expectations for some of those companies, because if you are expecting a gradual turn in earnings, a lot of these companies have a lot of built-in operating leverage. So as long as you get a little bit of growth, it doesn't have to be a lot, it can amplify to the bottom line, and that's where you could probably see some of that earnings acceleration. So that's really what we're looking at. They've already done the hard work in terms of bracing for a recession that has not happened or that was isolated to their particular industry or their particular community. And so if you see just some stability, maybe a slight bit of an acceleration in economic activity, that should really accrue to the bottom line and improve the valuation picture.
Hey, Brian, thanks so much for joining us. Really appreciate getting some of your thoughts there. Brian Jacobsen, he's a chief economist at Annex Wealth Management, joining us from Brookfield, Wisconsin, just a little bit west of Milwaukee. Again, you heard me say it before, I'll say it again, pound for pound. Some of the smartest money managers are in Milwaukee, Wisconsin.
That's right.
Exactly.
I have a lot of sources that are out there.
Exactly. Maybe it's University of Wisconsin. I don't know.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Jess Menton sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Brokers studio. We're streaming live on YouTube as well. And if you're listening to us in Boston, our new home starting September 3rd will be 92.9 FM. That's the day after Labor Day. Bloomberg Radio moving to 92.9 FM in Boston. Looking at Peloton, the stock's up 25%. I mean, the loss narrows. I guess sales came in a little bit better than expected. A pretty decent profit outlook. So I guess a turnaround plan here that people have been waiting to see some positive effects. Maybe that's actually happening here. Again, stock up 25%. So let's check in with Geetha Ranganathan. She's a media analyst for Bloomberg Intelligence. She joins us from Princeton via that Zoom technology thing. Geetha, what did you make of the Peloton's results? And is a 25% move higher? Is that warranted?
Yeah, I don't know about that, Paul. I think 25% might be a little bit of an overreaction. But then again, remember, it's down from, what was it trading at 160 or something during the pandemic?
167 at the beginning of 2021.
Yeah, 167 during, yeah,
That's
exactly.
when I was on the bike.
Right.
Yep.
So that's a drawdown of close to 100%, Geetha.
It definitely is. But, you're absolutely right, Paul. So there definitely were some green shoots from the fiscal fourth quarter results. I mean, up till this point, I think Peloton's management was really trying to do too many things at once. So they were trying to reinvigorate subscriber growth, and at the same time, they were also tasked with, reducing costs. And of course, those two are kind of a little bit incompatible because you need to kind of run promotions, you need to undertake a lot of marketing spend to kind of re-energize subscriber growth, and those two are just so incompatible with each other. So obviously now they're just focusing on the cost element of it. They're really right-sizing their cost base. What we're seeing is strong discipline across the board, and with that we've seen not just an increase in their profitability for the quarter that they reported, but also their guidance for fiscal 2025 was super encouraging. So their adjusted EBITDA forecast came in almost twice or double what consensus was expecting. But again, Paul, as we kind of think about the longer term strategy here, the question is, I mean, can there really ever be a turnaround in the true sense of the word? Meaning, can demand inflect? And so far, what management said and all the signs that we're seeing is the visibility is extremely limited. So yes, we can have some short-term gains in terms of, the profit metrics, but the long-term metric, which is really revenue and subscriber growth, I think that's going to continue to be challenged.
Looking at that all-time closing high, so it was January 13th, 2021, $167.42 there. You look where it's trading now, $4 and about 15 cents there. But when you're talking about this turnaround strategy, Paul and I earlier were talking about he has a couple different products from Peloton, but usually he's mentioning his girlfriend uses them more now than he does. But how do you get, as from a shareholder type perspective, because when you have an inflection point like COVID, obviously this was a stock that was one of those types of darlings, though. When it comes to demand, like you were talking about, how do they rectify that, and how do shareholders really view it? Because how do you get that stock back to even eclipse 167?
It's going to be very hard, Jess, to kind of get it back. And remember, this is a company that is in transition on many different fronts. So they actually do not have a CEO right now. So the CEO search is ongoing. So they're doing everything that they can right now, at least to kind of right the ship. So headcount reduction, marketing expense reduction. Obviously they're closing a lot of the retail showroom space, inventory. They're kind of right-sizing that. So they're doing everything that they can. But if you kind of look out at the long term, like what is the business model? Like we do need some kind of clarity on that. Do they get into different, modalities? I mean, they're principally really just a bike company. Even the treadmill really hasn't taken off in a big way. And even with their hardware, yes, obviously they're one of the best connected fitness products out there, but they've had problems with recalls and that kind of causing churn. So, again, will like getting into different modalities like the rower or even strength training, will it really kind of move the needle? I'm not necessarily sure, which means that the only other option for them is to really find a buyer. And there have been some rumors that, private equity companies might be interested. But then if private equity gets involved, then it really comes down to, trimming the costs even further. And just it kind of becomes more about like just extracting whatever cash you can from the company.
Hey, Geetha, let's switch gears to Paramount. It looks like we may have a bidding war there. Mr. Edgar Bronfman upped his offer today. What's the feeling about Paramount and how this might play out?
So it's getting very interesting, Paul, and I'm not really sure what Bronfman's endgame is here. So obviously he wouldn't get involved at this, kind of at this late stage if he didn't get some encouragement, in my view, from Sherry Redstone. And again, I'm not really sure what Sherry Redstone wants here. I mean, she ultimately kind of calls the shots. I don't know whether she's doing this because she wants Skydance to kind of sweeten their deal. Obviously, the $15 per share for the public shareholders was not something that sat well with them. Bronfman has kind of upped that a little bit. It's a $16 per share cash out, but we're not sure whether Sherry Redstone really is kind of manipulating this in any way, or whether she's kind of the voice behind this, or whether she simply wants to see Bronfman kind of have this bid just to make sure that there aren't that she's reducing her litigation risk. So again, it's a little bit unclear, but definitely I think Bronfman coming in, sweetening his bid, does set the stage in a way for a bidding war. So it's going to be interesting to see whether Skydance comes in and sweetens their proposal.
You've also talked about how a lot of questions still remain when it comes to some of the risks, including its valuation. So Class B shares of Paramount down about 24% year to date. Unpack sort of the valuation type issues that it's facing when it comes to a potential bidding war like this.
Yeah, so the valuation has always been a sticking point. And the major shareholder outcry against the Skydance proposal was that it was in fact only benefiting maybe two people, right? One was Sherry Redstone, and the other is, of course, the Ellisons and the Skydance team itself. Now, what Bronfman is arguing is that in his proposal, he's matching quite a bit of what Skydance has offered. The one thing that he's not doing is diluting existing shareholders. And the way that Skydance is diluting existing shareholders is by forcing Paramount to actually buy the Skydance studio at a fairly high multiple. We think that the multiple is about 14 to 15 times EBITDA. Meanwhile, you have the rest of the media landscape trading at about 6 times, and Paramount itself close to only about 7 or 8 times. So obviously a very rich multiple there for Skydance, again, diluting the shareholders, and Bronfman is saying his deal does not do that. When it comes to valuation, I mean, the reason that we're seeing, all of the media stocks challenge the way that they are is because of their heavy exposure to linear TV, which is in secular decline. And the writing is obviously on the wall because we saw both Paramount and Warner Brothers in their most recent quarter actually take huge programming write-downs. And so, as that exposure to linear TV remains high, this valuation is going to be a constant question mark. One could argue, though, that Paramount still has significant exposure to a very good film and TV production studio and should therefore trade definitely higher than at that $15 that Skydance was offering.
Geetha, once again, great stuff. Geetha Ranganathan, U.S. media analyst for Bloomberg Intelligence from Princeton. Jess, I hired a lot of really, really, really good people at Bloomberg Intelligence.
You did.
None better than Geetha Ranganathan. She's become one of the top media analysts on Wall Street in a relatively short period of time. So it's great stuff.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Jess Menton sitting in for Alex Steele. I'm Paul Sweeney. We're broadcasting live from the Bloomberg Interactive Broker Studio, and we're also streaming live on YouTube as well. Well, presumably, we're going to hear from Fed Chairman Jay Powell tomorrow, and he'll presumably confirm what the market believes, which that interest rates are soon to begin falling. That should be good for a number of asset classes, including real estate, both commercial and residential. So let's get an update there. Ben Miller is the CEO of Fundrise. Fundrise is the largest direct-to-consumer alternative asset manager in the U.S. Hey, Ben, again, it looks like interest rates are going to begin falling. How does that inform your view of real estate?
Yeah, for the first time in a while, real estate has a bull market tailwind. Basically, real estate is highly interest rate sensitive, and with the rise from interest rates going from 0 to 5%, 5.5%, that really hurt real estate prices, especially institutional real estate prices that price off yield. Now we're talking about rates falling by potentially 50%, from 5.5% to 3%, and that could have a huge impact on real estate prices.
And when you're talking specifically about those real estate prices, obviously there's commercial and then residential real estate, but you've talked about how apartments are likely to see a rally, but not necessarily as clear when it comes to single family housing. Kind of unpack that for us.
Yeah, well, so single family housing is priced by supply and demand. And so what surprised, I think, a lot of bears in the last couple of years is that high interest rates didn't lower single family housing prices. Actually, housing prices stayed healthy. And that's because most people have long-term fixed rate mortgages. The average mortgage is below 5%. I think 75% of people have a mortgage below 5%. And so the reality is that high interest rates really didn't impact the housing market like people expected. And home sellers didn't want to bring their house to market when interest rates were so high. So what ended up happening is supply of housing from existing homeowners was absolutely depressed. It's the lowest almost in history. And that low supply of housing kept prices up because prices are determined by where supply meets demand. So now, as interest rates start to fall, on one hand, that's good. It'll make housing more affordable. On the other hand, it may bring more houses to market.
That's kind of...
If more houses come to market, that could actually cause prices to actually stay dampened despite falling interest rates.
Right. And that's kind of where I wanted to go, Ben. I'm looking at the Mortgage Bankers Association 30-year fixed. It peaked kind of back in late 23 at about 7.9%. We're now down to 6.5. Where do you think mortgage rates need to go? Is there like a clearing level, you think, where the marginal seller would come back into the market and we'd get some more activity in the real estate, residential real estate?
Yeah, but my view is that mortgages will end up in the mid fives as most likely. But unfortunately, if you look at the last decade, the average mortgages were in the threes. And so for a house to get as affordable as it was in the 2010s, you really need not just rates to fall, but you need wages to increase. And that's going to take a long time. And so affordability is going to remain a challenge, I think, through the rest of this decade as we make progress on wages and bring rates down, but not to where they were last decade.
And when it comes to obviously higher rates and how that has slowed new construction, especially when it comes to apartments, what do you think that could mean for when we have the direction and the path for cuts potentially coming soon here, but not necessarily what it seems like, not at an aggressive pace, but even if it is more gradual, do you think that could ease some of the slowing that we did see with new construction for apartments?
Right. So just to recap, what happened was the low rates in 2021, 2020 caused a spike in new construction, especially in apartments. It's an all-time high. And that new supply started in 2021 and is delivering now. And so right now we're at all-time high. But if you look at starts or new construction, we finance and build a lot of housing. We probably are financing new construction in the thousands of units. And you're seeing that it's very difficult to start a new apartment project. A lender is very reluctant to lend. They're lending at low proceeds, so maybe 55% of the cost of the project, and at maybe a 7% interest rate, maybe even higher. So it's very hard to make it pencil, and so new construction is falling off a cliff. And as a result, by late next year, there'll be some of the lowest new supply in probably modern history. So we're going to go from an oversupplied to undersupplied market. And as a result, I think that we'll see rents continue to grow, rent prices continue to grow because of the falling supply of new apartments.
Hey, Ben, let's switch gears a little bit. On the commercial side, I think the most concern for most investors is on the office market. Where are we in terms of kind of flushing out and trying to find a bottom there? I don't see a lot of transactions that would help me to get a sense that maybe this market's bottoming.
No. I mean, there's a real fundamental change. I mean, the market has lost somewhere between 30 to 50% demand for office as a result of work from home. So from pre-pandemic to now, office occupancy is probably going to fall 30 to 50%. That will have a consequence to office rents and office prices. And that process is going to take at least a half a decade, another 5 years, I think, of decline, repricing, sort of compounding or vicious cycle dynamics. And so that is, I think, not only is it obviously bad for the $3 trillion of office, which probably will lose at least $1 trillion of value, maybe $1.5 trillion of value, but also for downtowns across the country, downtown DC, downtown San Francisco. I think the city budgets and the state of those streetscapes are going to see a lot of challenges that I think no one has like good solutions in the midterm. I mean, probably going to take half a decade to really find the bottom and really figure out how to rebuild those downtowns.
One question I have is when it comes to work from home. I know Paul's very passionate about this. We actually have a work shift column here at Bloomberg. And so there was an article earlier this summer where they talked about empty offices risk wiping out about $250 billion in commercial property values. So that U.S. office vacancy rate is forecast to hit a peak of 24% by 2026. If you looked at where it was sitting, basically in the first quarter of this year, it was around 19.8%, Paul. So I kind of wanted to pick your brain when it comes to what you're looking at this bin and that kind of dynamic from the work from home sort of aspect in your sort of purview in what you do.
Yeah, so Fundrise is a technology company and also an investment company. And so we understand a lot about both how technology affects the markets, and also we have 2 million users, 2 million customers. And so we have a really good sense of how people behave across the United States. And so the reality is that work from home is not only permanent, but I think we're still actually at the beginning of a cycle of technology affecting office. I mean, we saw this happen with e-commerce. In 1999, e-commerce was only 1% of all commerce. Now it's 16% of all commerce. And work from home today is approximately 25%, and I think it'll grow because we'll see more technological progress. AI will have huge impacts on the efficacy of working from home, virtual reality, driverless cars. And so I think that the extrapolations into the future are underestimating the impact of technology.
Yep, that's going to be a long-term trend. And again, for the commercial real estate, particularly the office, a profound one. Ben Miller, he is a CEO of Fundrise. We appreciate getting a few minutes of his time.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.